Oh, taxation with representation has not been such a good idea either. Good morning, everyone. The program is Gilbert Talks Taxes on WCAB AM 590, FM 100.9. Those of you live streaming, www.wcab59.com. So grateful that you're listening. Thank you so much. I get emails and calls all week from people that I'll have a question. They pick this up later on YouTube, or they catch the rebroadcast on the internet, which I think is great. And those of you that have stopped by this week because you listened to the program, thank you so much. So today we started right on time. Everything worked just fine. Microphones all working, Todd? My engineer this morning, Todd, good morning. Although, Todd, I do have some weird feedback happening here. That's not that right there? It's in the back room. We have back room feedback. That's okay. We'll work on that. Let Todd feverishly engineering here as he's Googling how to figure out how to get rid of background noise. My name is Gilbert Carmona. I'm an enrolled agent. An enrolled agent is a person that's enrolled with the Internal Revenue Service, U.S. Department of the Treasury. My license comes from the IRS. I represent taxpayers in all kinds of matters. I do tax returns. I do tax filings. I fix tax problems, not only federal but state level problems too. I'm also a financial planner. I have securities licenses. So I'm going to talk a little bit about financial planning. There's been a lot going on. I'm going to talk about the unemployment exclusion. First question Todd had for me as I walked through the door was about the unemployment exclusion, what's happening with that. Also going to talk a little bit about PPP. There's stimulus package money that's coming, or not coming, I should say, for people. And we've also going to talk a little bit about household employees and what to do with payroll and all these other things. Those of you know I've been on a theme the last weeks about executors and the executor's role in tax returns and tax return filings and taxes and what an executor has to do. It's a very complicated, big topic. So I've been trying to break it down into little piecemeals, little things, just nuggets along, because I could be like one of these national shows and do a 3-hour show just on the executor's role in an estate. And because we are in a retirement, I hate to call this area a retirement community, but this has become a retirement designation. We have a lot of older people living here, and this seems to be a lot of what's been going on. People, as they pass away, handling their estate. Many people have been prepared, or so they think they're prepared, and they leave estate, and they leave estate paperwork and wills and things, and then we find out where they were, where they weren't prepared, and how current things. So I'm trying to talk about this in the weeks, and talking a little bit about planning. I'm going to talk. So let me get into that real quick. One of the things I know Todd just wants me to talk about stimulus and unemployment exclusions. He's looking at me like, oh no. Where's my stimulus, and when am I going to get it? I'm going to get into that, Todd. I'm going to leave the people waiting on this. I'm going to talk about a topic, and I've talked about this many times. I've told the story of Marie, not her real name. Marie's father passed away, had a house, a car, some other assets, and an IRA. So Marie and her sister and her brother get together and do what most Americans do. They get competent retirement and a beneficiary advice from Mr. Google. Yeah, because why go see an attorney or an enrolled agent or somebody who actually knows what they're doing when we can just get online and Google it? And that's what they did. So they Google it, and they read. What happens is that you'll find what you want to find on the internet. Okay? Whatever you've already decided, you will find something that'll agree with what you've already decided. That's the problem. When you go see a professional, you're going to get the truth, regardless of what your opinion is. You're going to find out what the truth is. But when you go online and look, you're going to find whatever validates your point. And that's exactly what they found. They wanted to just take all the money, split it up, and each go on their way. So they found whatever they found online, and it said that inherited property is not taxable up to $5 million. And that is true. Inherited property is not taxable. But IRAs are, if they are traditional IRAs or they are 401ks or SEPs or Simples programs where the person put the money away tax-free. Because what happens is when you put money away tax-free, at some point the government wants their taxes on that money. So if the person that put the money away dies and a beneficiary gets that money, that beneficiary has to pay the taxes on it. It's a minor point that they didn't see when they were reading their information online. It's different. When you're a beneficiary, it's different than being an heir. It's different than being in the will and getting inherited property. Now, I know they call it an inherited IRA. So you're the beneficiary and you get an inherited IRA, but you're a beneficiary. The reason the difference there is the IRS wants to know, and I'm really simplifying this, the IRS wants to know who's getting that money because they want to know who's going to pay those taxes. And they're going to come after that person for those taxes. So Marie, her sister, and the brother divide up the property. The brother wanted the car. I think the sister and the brother split the house. They sold the house and split that. And Marie got the IRA. About $85,000, if I remember right, give or take. And they had split. Now, they all got about the same amount of money at the end of the day. Okay, it worked out fine. Everybody was super happy. First thing Maria does, is she goes and she cashes in that IRA and takes all the money because, after all, that's what she wanted, was the money. Okay, now they said something to her about taxes. The financial planner said something to her about taxes. She vaguely remembers hearing the word taxes as she was leaving, was filling out the paperwork and telling them where to deposit the money, but it was just some vague notion of some taxes or something, which she was sure the guy didn't know what he was talking about because, after all, she had inherited this and there's no taxes on inherited property. Okay, so let me fast forward 5 years later, approximately, when she came to my office for help. She had disregarded, I don't know, a dozen letters from the IRS and North Carolina, because they'll jump in and want their part of the money too at 5.25%, I might add. Her $85,000 inheritance became a $125,000 debt to the IRS and North Carolina. Okay, all because she didn't stop for 1 minute, get some competent advice, and learn what it is she had. Because there were all kinds of failure to file penalties because she didn't report it on her income. So what happens is even though you're the beneficiary of an IRA, you're the beneficiary of a 401k plan, a SEP plan, a simple plan, they're all pretty much the same. They all fall under the same tax code. So the person, the owner, passes away and designates you as beneficiary. Now, you may be the only beneficiary, or you may be the beneficiary with 5 other people. It doesn't matter. You're going to get your piece of whatever it is. Now, the person filled out a beneficiary designation form with whoever was handling that plan for them. So this is documented. This has nothing to do with a will. This has nothing to do with any inheritance within the estate. Okay? It has nothing to do, and I'm saying all this because I get these questions probably almost daily. People say, well, that IRA belongs to me. I'm the husband or wife. That's my IRA. Why? He left it to whoever. Well, whoever that person, okay, so the owner of the IRA can leave it to whomever, it's whomever, right? Correct? Whomever they want. They can leave it to a charity. They can leave it to another trust. They can leave it to an individual. They can leave it to a group of individuals. It has nothing to do with marital property. It has nothing to do with familiar relationships, family members. They can do whatever they want with it. So to finish Marie's story, So Marie learned a lesson. And when I asked her, I said, why did you let this problem go so far? I mean, the first letter from the IRS, you should have been on the phone to somebody. Something should have told you something's wrong. The IRS does not just send out letters. She said, well, I just didn't think they knew what they were talking about. They didn't know. I don't know, whatever. I didn't know why they were sending me letters. So she threw the first 4 years worth of mail out. She didn't actually take it seriously until she retired. She turned 65, and they garnished her Social Security and took money out of her bank account. The federal government garnished her Social Security, and North Carolina cleaned out her bank account. That's when she realized she had a problem. And it was a problem that wasn't going to go away anytime soon. So it's serious, and you need to know these things. So you designating the beneficiary, you're the owner of the 401, the IRA, please have that conversation with whomever you designate as the beneficiary and let them know. That's number one. Let them know that you are the beneficiary of this IRA that is tax exempt. They are going to now have a tax issue, which nobody ever complains about that. I mean, when they know what it is, they're like, oh, okay, well, we got to pay taxes on it. That's fine. Great. They're fine with it. It's when they don't know. And they're like, well, what is it? What do I have? What do I do with it? And then they go and do things like take the money out of it. Now, since that time, today, many of the financial back offices will automatically take 10% out. They won't. It used to be that they would just give it to you. They would ask you, and you would say, no, I don't want taxes taken out. And then they would just give you the whole amount. Today, some of them are requiring it. In some jurisdictions, state withholding is also required. So I've had this week several of these. Now, Roth IRAs are different. Roth IRAs are not, the money is not put away tax favored. We call that tax deferred. In a Roth IRA, the money truly is that you're going to receive truly is tax free. So with a traditional IRA or 401k, SEP simple, the money you put away is tax deferred. So you don't pay taxes on it when you put it away. That's the appeal. You can put up to, depending on your age, you can put up to $7,000 in an IRA. If you're over 50, you can put $7,000, under 50, $6,000 into an IRA every year, and that reduces your taxable income. If you have a 401k at work, whatever money you put away, depending on their plan, what their plan says, you put that money away, you don't pay tax on that money. And if they have a match, that's basically free money to you that you're putting away tax deferred. Why is it tax deferred, Todd? Because you're going to pay the tax in the future, but you are going to pay tax. Okay, don't be like Marie. Marie's $85,000 turned into $75,000 of interest and penalties for not doing this right. So I can't drive that point enough. Again, she ignored the problem for so long. It was a 25% failure to file penalty, then another, I mean, I can go on. And then just the interest, because it took her so long to pay it back. I mean, she didn't have the money to pay it back. She had to pay it back at 15% a year of her Social Security. And it took years. Last time I talked to her, she still had some debt. North Carolina didn't fool around. They just took it all out of her bank account and said, thank you and goodbye. I was able to help her with a few things and get a few things corrected, but the damage has been done. Once you've taken the money and spent it, the damage has been done. So owners of these policies, please tell the people. Now, with a Roth, the money's put away after tax dollars. You've already paid tax on it, so all the money you pull out is tax-free, including the gain on the money. Okay, so a Roth is truly a tax-free proposition. So beneficiaries of a Roth are not going to have the problems other than the 10% penalty for early withdrawal under age 59 and a half. If a young person or a younger person is the beneficiary, they need to be aware that the rules apply to them. So if they pull them out under 59 and a half, they're going to have a 10% penalty. Otherwise, the money truly is tax-free money in those scenarios. The other thing that we're seeing a lot of this week is, or I've seen a lot of this week, is no beneficiary designation. I helped someone yesterday. They did not have a beneficiary designated on their IRA. They had a traditional IRA. It was an inherited traditional IRA. We were going over all the paperwork, making sure everything was done correctly. And in it, I noticed, being the astute financial planner that I am, I noticed, although it's usually my wife Christy that catches this kind of stuff, she's the one that combs the paperwork. And she always goes in behind me. That's her job. She goes in behind me. We try to have two sets of eyes look at everything, and then of course the back office looks at everything one more time. But she's the one that catches all those. But I caught it. There was no primary or secondary or contingent beneficiaries. And I said, well, now you've inherited this. Now you need to have beneficiaries on there. So we called the people holding the money and faxed it in. Because when you fax it in, as soon as it gets on that fax machine and they receive it, that's it. It's good. Okay? You don't have to worry about mailing stuff in, it being lost in the mail. Those things always make me nervous. Until they get it and I get a confirmation back, they don't have it. At least with faxing it, we know they got it. Central processing got it. They received it and told us we were good to go. Because things happen, and things happen quickly. And you find yourself in a mess. I have had more than one where a person has passed away and the beneficiary had predeceased them. Todd, that's legal language for they died before they did. The beneficiary died before the owner of the policy did. So be aware to keep those things current. Okay? It's very important that you keep those things current. Let's take a quick break here, Todd. It's time, really? 18 minutes has already passed? That is... Todd's laughing at me. That was really quick. It went by really fast. I just enjoy talking about this subject so much. Time just flies. This is Gilbert Talks Taxes, WCAB, AM 590, FM 100.9. I want to tell you about a little-known Rutherford County gem, Integrity Marble and Granite, located at 287 Shiloh Road in Forest City. They are the premier stone fabrication company in the western North Carolina region. They specialize in granite, marble, and natural stone, offering complete design and installation. Their design center and Kohler showroom features vanities, decorative accessories, bathroom, and kitchen fixtures. You do not have to go to Charlotte or Asheville for this kind of quality. We have it right here in Forest City. Stop in their showroom and browse their beautiful displays, or you can call 828-247-8801 for a free quote. You can also go to their website, www.integritymarblegranite.com, and look at the pictures and see samples of their available materials. Now, mention you heard it on Gilbert Talks Taxes, and they will give you $100 off any sink purchase. That's Integrity Marble and Granite.
When you get a hankering for lunch, remember Jesse James Railroad Express. They have a menu full of delicious items such as burgers, chicken salad croissants, fresh salads, hot dogs, taco salads, and much, much more. Don't forget the refreshing drinks like milkshakes, Coke floats, or hand-dipped ice cream. They are now serving French fries and onion rings. Hours are Monday through Saturday, 11 a.m. until 4 p.m., closed Wednesdays and Sundays. For takeout, give them a call at 828-447-4644, located at 531 Railroad Avenue in Rutherford. Don't forget, Mondays only, 99-cent hot dogs with mustard, chili, and onions. That's Jesse James Railroad Express. All aboard.
Good morning. We are back. This is Gilbert Talks Taxes, WCAB, AM 590, FM 100.9. Those of you live streaming, I had a request. They wanted to see Canyon, so I had them come in. Those of you live streaming, that's what that was all about. I know you can't hear us when we're on the break, but you can see us. That was Canyon. He takes care of all my water needs. during the breaks because I drink a lot of water on these breaks. We are back. The program is Gilbert Talks Taxes. My name is Gilbert Carmona. I am an enrolled agent. An enrolled agent is a person who's supposed to know what they're talking about when it comes to taxes. That's why I have this program, although lately, the way they're changing the tax law, I'm spending as much time just reading up on it as I am actually doing tax returns. This is the first time ever we've had tax law changes in the middle of tax season in my 24, 5, 6, time goes by, 6 years of doing this. This is the first time we've ever seen this. If you need to reach me, my office number is 828-289-9300. You can send me an email at gilbert@gilberttalkstaxes.com. And I've got an office right here, 113 Whitesides Road, Rutherfordton. I've got another office in downtown Tryon, 226 South Trade Street, the beautiful Art Deco building right off the historic downtown Tryon. Let me get right into this topic. This is the topic that everybody wants to hear about right now. Unemployment exclusion. This is an update from, and I actually got this email. I got it Thursday at 4:04. Todd, right there. See, look at the date on this. This is email IRS update. Unemployment exclusion. The Internal Revenue Service has announced that it will take steps to automatically refund money this spring and summer to people who filed their tax returns reporting unemployment compensation before the recent changes made by the American Disaster Plan. I'm sorry, that was the American Rescue Plan. The IRS states, this is a quote, "There is no need for taxpayers to file an amended return unless the calculations make the taxpayer newly eligible for additional federal credits and deductions not already included on the original tax return," unquote. I am really trying to read this with a straight face. Now let me go back to the email. You'll want to review returns filed with unemployment compensation prior to the exclusion to determine which returns need to be amended in order to receive any additional federal or state tax breaks. Okay, there's another email that they released. Oh, it gets better, Todd. The IRS to recalculate taxes and unemployment benefits refunds to start in May. They're going to start them in May. Okay, so let me give everybody a little background on this. Unemployment compensation, and we warned everybody last year that this was going to happen because we knew it was coming. People got unemployment compensation. Unemployment is taxable. It's just like it's regular income. It is taxable. Okay? So when you go and you file for unemployment, they even ask you, do you want federal and or state taxes withheld? They do a flat 10% federal, they do a flat 5% state. Okay, now for people that are going to go on unemployment where it's a short-term thing, they know it's a short-term thing. Sometimes the plant may be shutting down where they work, may be shutting down, or something like that may be happening where they know they're only going to be on it for 3, 4 weeks, 5 weeks, 6 weeks. Okay, withholding's not going to be a big deal. It's not, it's just not, you may owe a little bit at the end of the year, and it depends how much you're getting under normal circumstances. Because remember, unemployment is a fraction of what you normally get, depending on your income and all that. Now, if you're a higher income person, and you're getting a higher income, then maybe you may want to have that withholding. But if it's just a short-term thing, couple of weeks, it's usually not, what we have seen, usually not a problem. Well, this was not normal unemployment. This was regular state unemployment, and then the federal government threw in another $600 a week on top of it. There are people that made as much money or more money sitting at home than they did working. We all know that. We've all met these people, okay? I had a husband and wife team that were both on unemployment for like 7 months. They made more money on unemployment than they did working at their regular jobs. They had zero withholding. Okay, so we were warning everybody because the state agencies were getting back to the preparer community, and they were telling, and it was in the news, it was in the media, it was all over. They're saying 80% of the people are not withholding. We need to be warning people this is taxable income. They're going to owe money. Worse than owing money, you've got people that have children. They get earned income tax credit, they get child tax credit, they get additional child tax credit. That's based on your income. It's earned income tax credit, right? So what happens is now people that normally would get, and I'm just making a number up, would normally get $5,000 or $6,000, we're now only going to get $1,000 or $2,000. And what happens is they're ready to get that $5,000. This is what in their thinking. It's in their budget. It's what they usually get. So we were all fall. We were warning people. You may or may not have seen there were headline news about it. I know we reached out to our people and let them know, if you're on, meaning my clients, if you're on unemployment, be aware it is taxable. Okay, so we prepped everybody. Nobody, it was still remained at 80%. People said, no, we don't need it. The state of Alabama didn't even allow you to have withholding. They totally took that out of the system because, again, this was intended to be a short-term fix. They didn't think people would be on it or get as much as they did. Okay, so this affects other things because on your tax return, no one item is a standalone item. Typically, income affects tax credits, affects self-employment earnings, affects if you have children or if you yourself are getting college credits. If you're getting, there's all these credits, Schedule A, all these things. If you are on Obamacare, ACA, Affordable Care Act, that's something we haven't talked about in years. It's so become not a thing, but it still is. People still are on the Affordable Care Act, and they still are highly subsidized. And there are people that if you make too much money, you have to pay it back. If you're under-subsidized, meaning they didn't subsidize you enough, you're getting additional credits for it. All this is based on your income. All this is driven. Okay, so March 11th, Congress passes this law. President what's-his-name signs it, and it becomes law, retroactively going back and changing a lot of things for 2020. First time this has ever happened. We have never had a law change in the middle of tax season. It literally upended everything. So unemployment is now tax-free, but not all of it. $10,200. That's it. $10,200, so up to $10,200 is tax-free for 2020. Well, they did this March, I think it became law March 11th, March 12th. By middle of March, and I thought it was just so funny because it just shows how naive they are in Washington. How either they're naive or they're out of touch with reality. But we were getting emails telling us to stop filing tax returns till they got this law all worked out, that it could be till the end of March. I'm thinking there's nobody going to stop not file their tax return to get their refunds, especially when you're connecting the stimulus to it. People want those stimulus payments. There's just no way. And sure enough, it didn't slow anything down. And on the contrary, more people were filing their tax returns. So they wanted us to stop filing tax returns. Well, of course, we didn't. By March 13th, I can't remember how many, 50 million, 60 million tax returns, it may even have been more, had already been filed. So what happened to all the unemployment that was on those tax returns that people paid taxes on? That's why we're having this problem. Okay? And I forgot the number, but it's a big number. So the preparer community said, we're going to have to go back through all of those tax returns and number one, see who had it and who didn't. Now, there's a way the software can pull those out. So there's a way we can do it. But now we've got to reach out to all those people, and we've got to get them back in the office, and we've got to do another tax return, an amended tax return for them. The IRS said, no, you don't have to amend. As a matter of fact, they told us to tell people not to amend. I even had somebody call me here Saturday, Todd. Do you believe that? Last Saturday. Somebody called me and wanted to know when they could come by my office to amend their tax return. It is. I told them, no, you don't need to do that. but that's how important this is that people are even calling their radio station asking me about it. So they said no, but now they're saying don't amend unless the calculation makes the tax, and I'm quoting, unless the calculation makes the taxpayer newly eligible for additional federal tax credits. Well, every change in income affects your federal tax credits and deductions. And everybody in the preparer community is saying, well, who's going to pay us to do this? Because now you've got to go to these taxpayers who've already paid to have their tax return done, and now we have to amend their tax return, which can be, in some cases, it can be just as much work as doing the original tax return, because you've got to go in and change it. You've got to, I mean, it's not just pushing a few buttons. It's a whole procedure to do this. And they're saying, well, who's gonna pay us? Because I guess at some of the bigger firms, I haven't spoken with anybody about it yet, but in some of the bigger firms, they were having people saying they were expecting the firm to do this for, as part of their service. Well, no, they're not going to. And now the IRS said, wait, but we're going to see. This is still going to be in the news, but if you had unemployment and you filed your tax return and you paid taxes on it, just be aware you're going to get a refund from the IRS. How much could it be? Depending on your tax return, this could be a couple of $1,000s. That's the bottom line, is people don't know, well, how much money are we talking about? Well, it depends on your tax bracket. $10,000, you're in a 22% tax bracket. That's $2,200 and change. So, yes. Oh, yes, Todd's shaking his head. Yes, that is a thing. Now, stimulus, I'm going to take a break real quick. Stimulus. A lot of people got checks in the mail. As a matter of fact, I just got an email this morning about somebody who got a $1,400 stimulus check yesterday. I've actually had several people come by my office. Yesterday, I had a man come by my office with a $1,400 check in his hand. And he said, I just got this in the mail. What is it? I said, it's a $1,400 check from the IRS. And it's a stimulus check on it. It says it right on there, on the lower left-hand corner. It's a stimulus check. So it is a stimulus check, and that was followed by a lady who got an $8,400 stimulus check. Wanted to know what that was. I said, it is a stimulus check. What surprised them was they were expecting this money to be direct deposited into their bank accounts, and they got it as a check. That's what surprised both of them. It was, why did this not go into my bank account? They thought it might have been like, is this real? Can I cash this? I mean, people haven't seen an IRS check in so long because everything's direct deposit and everything's done through the banks that, I mean, I can tell that little envelope a mile away. Of course, I'm old, but this new generation, they haven't seen an IRS check. They're not used to it. They thought it was like a voucher or something. So now you're having that problem. People are getting these checks and don't know what they are. And how many of these are not going to get deposited? I'm really wondering. You know that they were using part of the stimulus for whatever reason. There were people getting a debit card, and they were putting their stimulus money on a debit card. Well, people didn't realize the government's reusing that same debit card to put your third stimulus on. So people spent their $600 or their $1,200. Oh, threw that card in the trash. Yeah, they tossed the card. They left it there at the register. One person left it at the register at Walmart because they cleaned it out. No money left on that card. They just left it right there. That card's going to get reloaded or probably already was, reloaded with the $1,400. Now they've got to go through the hassle of getting another one from the IRS with their 3-hour hold time on the phone. It's a mess, and it's just a mess because it's just the lack of communication. So many things are happening after the fact. Okay, so I talked about that. I talked about unemployment, and let me talk about. Well, I'm going to talk about North Carolina. We've got to talk about North Carolina PPP and North Carolina and how they're handling the unemployment exclusion. Oh, you're going to want to tune into this one. WCAB AM 590, FM 100.9. This is Gilbert Talks Taxes. We'll be right back.
Hi there, this is Kimberly, and I'm here to tell you about Peterson's Auto Service and Detail Shop. As a woman, I'm often apprehensive about taking my car to a dirty service garage. But you can be assured that Peterson's, located at 478 Butler Road, Forest City, has an incredibly clean and safe environment where you get high-quality service at a great price. Peterson's was voted Rutherford County's best auto service 3 years in a row. So take your car to Peterson's for brakes, oil change, North Carolina inspection, tire rotation, headlight lens restoration, scratch removal, and meticulous auto detailing. That's Peterson's at 478 Butler Road, Forest City. You can call him for an appointment at 245-8889.
This is Gilbert. If you owe the IRS past due taxes, don't call those toll-free national numbers. Local, affordable help is right here in Rutherford County. Stop garnishments, levies, and liens. Call Gilbert Carmona at 828-289-9300. All initial consultations are free. Call Gilbert, 828-289-9300.
We are back. This is Gilbert Talks Taxes, WCAB, AM 590, FM 100.9. My telephone number is 828-289-9300. You can give me a call if you have any questions. You can send me an email, gilbert@gilberttalkstaxes.com. So the question is this, getting back to the topic of unemployment exclusion. So the topic is, what do you do? Do you wait? Do you go ahead and amend? The advice that I would give you, and this is an executive decision that I just made, because I've been wrestling with this all week. What do we do? And everybody I talk to, in the industry, we talk to other CPAs and other tax attorneys and other EAs, and we all kind of kick around, what we think, because we're not getting any guidance from the IRS. Okay, we're just not getting any guidance. We get answers from them like, well, you may want to wait. Well, we may want to. What if we don't? Well, or you may want to get it done now. And that's the kind of stuff they say to us. So we're like, okay. And if you call and you talk to 3 agents, you're going to get 3 different opinions. Because they don't know. It's the lack of guidance, just the lack of a concrete plan. And we don't know. They don't know. Well, we don't know. We're waiting to see. We're waiting for guidance. There are still tax forms that can't be e-filed. And here we are, April 3rd. And there are forms that we cannot e-file because they haven't made a decision on what they want to do about it, because this new law has affected it. I know. So there are tax returns that cannot be e-filed yet. It's granted, it's a few. It's just a few loose ends that they have. But again, did I mention it's April 3rd? This is kind of stuff we usually know. We're ready to go end of December. As a matter of fact, we used to get all nervous about the extenders. Extenders are tax laws that we say they sunset, they expire December 31st. They expire. And then they're going to decide if they want to have them go into the next year. So Congress has to meet, and they usually do it in their last session of the year, and they go through this whole list of laws that are going to expire. We call those extenders. Do they get extended or not? Some do, some don't. And then we wait with bated breath to hear, because some of these are huge. They're big. They're tax credits. They're whatever. The tax law, and it matters, and it affects things, and we've got to scramble and change financial strategies and change tax planning based on if these extenders are going to be law or not the following year. We have never had a tax law change in the middle of the tax season. That has such an impact. I mean, I can't say it enough. Okay, now, to further complicate things, North Carolina. As of today, North Carolina has not, they are not excluding unemployment income. So while the federal government has excluded it, North Carolina is not. Unemployment in North Carolina and South Carolina and many states, unemployment is still taxable. in North Carolina and South Carolina and lots of other states. Okay, so the federal government said we're not making it taxable. North Carolina said no, we want our money. So it is still taxable. Also PPP, Payroll Protection Program money. Even though it is exempt by the IRS, North Carolina is still taxing as of now. As of today, they are still taxing PPP money. Now, they are going to have a meeting down there in Raleigh on, I forgot the date, but it's going to be in June. They're going to be meeting, and they're going to be hopefully doing what the IRS does, because they said in the fall, when the IRS was taxing PPP, they said, we're going to do whatever the federal government does. And then when the federal government said in January, we are excluding PPP, North Carolina issued a letter February 11th saying, well, we're still taxing PPP. So it was too late. A lot of tax returns had already been done, because business tax returns can be filed pretty quick. They weren't excluded. They were, we're filing business tax returns second week of January, and because they have to be done. They need their deadline's March 15th. So they came out a little late, February 11th, and said, well, we're still taxing it. But then some legislation got introduced, but they were out of session, so they couldn't debate it. They're going to be debating it in June. So we're keeping our eyes on that. But unemployment is still taxable. Now, an important thing that everybody needs to know: if you owe money to North Carolina this year, the IRS extended filing season to what date, Todd? May. That was a pop quiz. May 17th. Okay, so your filing season has been extended now to May 17th. That is an extension to file and pay for the IRS, not for North Carolina. Filing season has been extended till May 17th in North Carolina also to file, but not to pay. If you owe money to North Carolina, it is still due April 15th. Now, you don't have to pay it till May 17th, but you will pay interest from April 15th till the day they get the money. Yes, to further confuse everything. Okay? So the IRS extends the deadline, but not North Carolina. Now, to further confuse everybody, let's talk about estimated tax payments. We all just assumed that estimated tax payments were also going to be extended till May 17th because April 15th deadline got extended, right? Oh no, not for estimated tax payments. Estimated tax payments are still due April 15th. I know, this is very confusing. Estimated tax payments are due April 15th, they're due June 15th, they're due September 15th, and they're due January 15th of the following year for the previous year. Okay, those dates have not changed. So if you are a person that files estimated tax payments, those are still due April 15th. How do we even keep up with all this? I actually have I have this all written down on a calendar in front of me because I can't keep up with it otherwise. And remember, I said in January when the IRS commissioner said, please, let's not extend anything. It just causes confusion. Let's leave everything the same. If you want to give people a break to pay, fine. Just make it an automatic extension to pay, and that'll give people an opportunity, make them have no penalty and no interest. But they said, no, we want to move the dates. And he really fought it all the way till he fought it for 2 months. I mean, I give the guy's has more backbone than I thought. He fought it all January, all February, and all the way into March. And finally, March 15th, he gave in and he extended the April 15th deadline for 1 month. But he said, we really don't need to do this. And he was right. We really don't need to do this. Okay, so Todd, did you get all that? Did you? I know, Todd. And I'm going to get back. We're going to talk about a little tax planning. Forget about all these deadlines. Talk about tax planning, employee planning, and company payroll. This is Gilbert Talks Taxes, WCAB, AM 590, FM 100.9.
As we get ready for this year's tax season, there's one thought on everyone's mind. Will Gilbert's hair look fabulous this year? Oh, yes, it will. How can I say that? Because I go to Robin Saunders at RSL Salon. Whether it's a good haircut, a pedicure, or a manicure, you can count on RSL Salon. Call Robin at 828-289-9110 because everyone deserves to look fabulous. People come up to me and say, Gilbert, thank you for doing my tax return and thank you for getting me that big refund. Do you have any ideas what I can do with that refund? Oh, yes, I do. Take that refund right over to NC Tractor and Farm Supply, talk to Phil, get you a brand new shiny red Massey Ferguson. That's NC Tractor and Farm Supply, Railroad Avenue. You can call Phil at 828-429-5008. By the way, mention you heard it on Gilbert Talks Taxes. I'm hoping he'll give me a discount when I go buy my brand new shiny Massey Ferguson tractor.
We are back. That was the last break. Gilbert Talks Taxes. Yes, my hair does look fabulous this year. What's left of it after this tax season? It looks great. I'm wearing those of you live streaming, www.wcab59.com. I'm wearing my vintage Soho tie today. Nice, bright spring gold color. And it's a beautiful day out there today. What's the crisp morning, 33 degrees out there right now here at the studio. Those of you listening, thank you so much. If you need me, my telephone number is 828-289-9300. Send me an email, gilbert@gilberttalkstaxes.com. And I try to be upbeat and positive about all of this and give good advice and tell people how wonderful the IRS and everything is. And they're great. They do a great job at what they do. They're even challenged. You know, it's hard to be upbeat and positive about this. It just is. And in the break we were talking, and that is a scenario. What we do, you know, I'm an analyst at heart. That's really what I like to do. My minor is actually in computer science. My major is in accounting and business administration, and my minor is in computer science. And I love analytics, and I love the research part of it. And so, as we were crunching numbers and creating spreadsheets to see possible scenarios with all of this, Todd, you just nailed it with your question. What if this creates a scenario where I possibly owe more money to North Carolina? I've already filed my North Carolina tax return, and I find out after April 15th, that I owe more money to North Carolina. Well, then you will owe more money with interest and penalty to North Carolina. Or what if you end up not? But you've got to go through it to see. You've got to go through it to see, and you're just going to have to redo these tax returns to see what exactly is going to happen with all these scenarios. And that is literally computer time. Somebody sitting there, inputting these numbers, moving these numbers, adding them and removing them, and seeing what happens. Unless you work for a colossal company that has the kind of software that can just do all this stuff, that can pre-program this in. But this is way beyond the average tax preparing firm. And when I say the average tax preparing firm, I'm even talking about big CPA firms that have many partners and many staff. I mean, this is really a lot of change. Okay. One thing, although in Rutherford County, this hasn't been such a thing, I have clients, as most of you know, I'm an enrolled agent. I have clients all over the country. I can represent any taxpayer in the whole world that has to file an American tax return, and I do have clients in other countries. I even have a client in Australia now, if you can believe that. He is an American working there that has to file a tax return here because he's an American, and he has to file American taxes. So, but in the bigger cities, you have people that are involved in the gig economy. And you've heard this word before, right, Todd? The gig economy. That is Uber, DoorDash. What's the other one? What's Uber's competitor? Lyft. There are freelancers that are just beyond the scope of your normal, what we used to consider your normal freelancing. There are now people that are doing very highly skilled jobs. I actually have a client that is a translator. She is certified to translate very complicated legal and medical documents into 3 languages. You know, she does German, she does Portuguese, she does English. She is a freelancer. Okay? This is the gig economy. I have another translator. She works Spanish to English, English to Spanish. Medical transcription. That's her specialty, is medical transcription. And it is a specialty. Those words, those big, long medical words. She has a whole database of them, and she does this. So these are people that, this just goes beyond the traditional working from home model. Obviously, you know, with Lyft and Uber, these are people in their cars. Well, the IRS has been trying to get their hands around these people for a long time, because there's a lot of issues with them working, and the IRS is worried they're not going to get their money from these people, because you've got a lot of things like tips. And now your traditional freelancers that worked for a company, gave the company an invoice, the company paid that invoice with a check. If it was over $600, the company gave the freelancer a 1099. But what we're having now is small projects. A lot of them are cash. They're just not, there's no paper trail, there's no nothing. And while when you think of it at the level of just a transaction between a couple of people, it may just be a couple of $100. Nationally, you're talking about billions of dollars, and billions of dollars in tax revenues that the government would like to get their hands on. The American Rescue Plan is really targeted them. There's actually provisions in there that are designed to help workers keep track and correctly pay their taxes, as the IRS likes to refer to it, to correctly pay your taxes. There's a new requirement, and it's actually an amendment to the U.S. tax code that got attached to this American Rescue Plan, and it requires platform companies like Uber and Lyft to inform contract workers of how much money they have made on their platform, whereas before this wasn't as big a deal. It is becoming more and more of a deal now, and there are new filing requirements. All I want to say right now, I'm not getting into the law of it all, because we really don't know all of it, to what extent this is going to affect all of you gig workers out there. And it's really, Lyft has become a thing now. I don't know anybody that uses a traditional cab anymore, unless you're in a big city, and that's usually where, you know, the old yellow cab was entrenched. But right now it is Lyft and it is Uber if you want to get around, and they're the ones, your best choice. So there's going to be a lot coming down the pipe with this. Just be aware. Your platform providers are going to be informing you of this. What I'm concerned about, what I'm just warning people is, I don't want you to get sandbagged that with the requirements that you may not be aware that you have these requirements. So as always, just track all your income, track your tips, track your expenses, track the drivers that are using their mileage. Be sure to keep good, accurate mileage logs, because in an IRS audit, that's what they're going to want to see. They don't want some vague answer about how many miles you drove. They want to see an actual log, and what your platform provides you. Be sure to back that information up and download it and have it accessible. I have been in audits where the people no longer have access to these apps that are supposed to be tracking their business mileage or tracking some part of their business, and they may have gotten a new phone or a couple of new phones by now. By the time you get audited, because you're not going to be audited, this month on last year. It's going to be for the year before or even the year before that. So there's a lag time there. So they don't remember what app they used. They don't remember how they tracked it. They don't remember, and they have no hard copies and no backup digital copies. So I'm just warning you, they're really cracking down on this. So those of you that are in that, and this is beyond just a traditional freelancer, because most freelancers know there's actually a law working its way through Congress right now that is aimed at eliminating reclassifying workers, that was going to have a huge impact on traditional freelancers. Basically, it is going to make, and this law hasn't become a law yet. It's a bill now, but everybody's closely watching this, because it's basically going to eliminate freelancing as we know it. And how the states are going to react to this, it's anybody's guess. We don't know enough about it yet. So just be aware, all you gig workers out there, freelancers, there are people that just, and really a lot of them aren't doing it because the money's so great. They're doing it because they want freedom. They don't want to work for a company. They don't want to do Monday through Friday 9 to 5. They've got other things. They take care of elderly parents. They've got children. They want the flexibility. I mean, I know my one lady that does the medical transcription. She says I couldn't go into an office. Now I love working from home and all the things. I mean, she says I've got my spring garden to take care of during the day, and she likes to work at night. So this is going to change. Things are going to change. Rules are going to change. So be aware. Okay, now I'm going to talk about household employees and employers. So this is real quick. I'm going to last. How much time we have left, Todd? 4 minutes. 3 minutes now. Thank you, Todd. The employers, I'm going to talk to you 1 second. The IRS has ruled, they just made a ruling, that household employees are not considered direct contributors to the success of a business. Okay, so let me give you the background. You're a businessman, you own a business, you have payroll, you have employees that work for you. You've also got some people that might work for you at home, at your home. They work for you. They take care of your home. They do whatever they do around your house. They're whatever, but they're not actual employees of the business that you're at. They're somewhere else doing something else for you. You can't just lump all these people together. Okay? So these household employees are not considered direct contributors to the success of a business. Therefore, businesses cannot include us household employees' payroll expense on their payroll tax deduction. For most types of business entities, wages paid to a household employee cannot be reported on the company's employment tax filings. Okay? So the solution is, and this is a big deal for a lot of people, because they may have separate things going on, and they may have employees that are not part of the business day to day. They're doing other things, but they're on the payroll. Instead, it should be handled separately through the household employment reporting process. If the expense is for dependent care, the family can take the dependent care tax breaks associated with those wages, but it must be handled on their personal income tax return. So these household employees must be handled, that you're paying, must be handled on your personal income tax return. I didn't think this was such a big deal, but I started looking at the numbers, and even in our own clients, and this is a big deal. This is going to affect a lot of people. So just be aware, if you've got people working for you, and you're putting them on your payroll at your work, but they're doing household work like dependent care, house caring, grounds maintenance, whatever, at your household, you cannot lump all those payrolls together. Okay? If you have any questions, give me a call. 828-289-9300. You can email me, Gilbert@GilbertTalksTaxes.com. Well, Todd, thank you. It's been a great program today. I will be back next Saturday. Hopefully there won't be too many law changes between then and then. This is Gilbert Talks Taxes, WCAB, AM 590, FM 100.9.
100.9 FM, 590 AM WCAB Rutherfordton. Get your local weather at 5 past the hour here on WCAB.
When you get a hankering for lunch,